How much revenue will be raised from the tax hikes on million-dollar-plus earners? Our wealth editor, Robert Frank, has been crunching the numbers. Robert?
Thanks, Mary. Well, it's not a lot, at least by government standards. Let's take a look at the two definitions of rich here. The first is the Obama rich. We know those are folks who make $200,000 or $50,000 or more a year, about 2.8 million of them. The Obama rich, they account for about 2% of total tax filers. The Boehner rich, were there a little more of an elite club. Those are folks who make $1 million or more a year. There are about 368,000 of them, about 2/10 of the top 1% of tax filers. Now, because the Boehner rich are such a small group, raising taxes on that group raises a lot less revenue. If we raise taxes to 39.6% on the Obama rich, we get around $44 billion next year. We raise taxes on the Boehner rich, well, that gives us less than half that amount, about $20 billion. Now, aside from their smaller numbers, the Boehner rich also get more of their income from capital gains, which are, of course, taxed at a lower rate. So raising their income tax rate has less of an impact. Of course, $20 billion is still a lot of money, and Boehner's offer is just a starting point. They could agree to a midpoint of $500,000 that would net around $30 billion a year. But in government terms, Maria, Boehner's plan is more valuable for its politics than its economics. Back to you.
All right, Robert, thank you so much.
Thanks.
Robert, stay with us. So the tax revenue from the Boehner rich may not make much of a dent when it comes to the deficit. That is what you're telling me. But what does it mean for the spending and investing habits of those directly impacted by such a bill, a higher tax bill? Joining me right now, Martiak of Premier Wealth Management and Ron Weiner of RDM Financial Group. Once again, our own Robert Frank also joining the conversation. Great to see you guys. Thank you so much for joining us. So, Mark, you say the changes won't really impact spending habits. In other words, if the rich see their rates go higher, you don't think it's going to impact what they spend their money on?
I don't think it will impact their lifestyle at all, Maria. In fact, the only time, at least my clients, wealthy clients, high net worth, ultra high net worth clients, when their spending habits are affected, are when their portfolios are down on during any given week. So I don't think it'll affect their spending habits whatsoever.
Well, I agree with you. I mean, we're focused so much on these ordinary income tax rates, but the fact is aren't the investment taxes much more impactful, the tax on cap gains, the tax on dividends?
Yes, they are.
That's what I have been worried about.
I couldn't agree more. They are very, very worrisome, and that's why many clients are sitting on the sidelines right now, and they don't want to do anything. They've wanted to buy into a year-end rally, but they're hesitant. When you don't know the playing rules, especially when there's so much disorganization in Washington, there's no reason for the clients to step onto the playing field and get involved. But when you add other taxes now, not just cap gains taxes, long-term and so on, now you're talking about, for high-income cities like New York, you're talking about 53% plus another 3.8% with the Obamacare, Medicare surtax.
So 53 or 57% of the wealthiest out there, 57% of their income is going to the government when you consider federal, state, and city. Then, Ron, you also agree, even with that, the habits are unlikely to change.
Well, that all depends. Someone making $1 million, 100,000 from dividends, 85 from capital gains. Under the 250 rule, they're going to see their taxes go up $70,000 or so. Under the $1 million proposal by Boehner, that's going to be about a $30,000 increase. $30,000 is not that much, but it is after-tax money.
Right.
$70,000 is another number. I think it will affect them somewhat. I'm worried more about their future, of what they're not going to be saving, that they'll be saving less, and even the wealthy have to worry about the future.
All right, so how does it impact then spending, and give us the ripple effect of these higher tax rates and how that ripples down?
Well, you're talking about $6,000 a month out of their pocket. That $6,000 is often today going to their kids, going to gifting, and it's going into the market. All that will get shut off, and that's going to affect them. The savings rate on that $6,000 10 years from now, 20 years from now, is what's going to support that lifestyle down the road, and they're going to live a long time.
Robert, what about the people that you're speaking to? What's the expectation for spending and investing as these rates come into play?
Look, I think it really depends on the segment. You know, you're talking about someone who earns $1 million or more a year, probably not a huge impact, but that's why these definitions of rich matter so much. 250 and below, 250 and above, that's a large segment of people, again, more than almost 3 million people. These tax rates do matter. $1 million above, not so much, but we've already seen how these rates, or the threat of them, are changing behaviors. People are selling selling homes, they're selling businesses, and they're selling stock in advance of these increases. So it may not change shopping this holiday season or day-to-day earnings, but we're seeing a huge amount of income shift to this year from next year.
That's what I'm talking about. Exactly right, Robert, because you already see people saying, okay, the capital gains number is 15% right now. Why shouldn't I sell my home by year end? Why shouldn't I sell the stocks that I've made money on, knowing that cap gains probably goes to 25%?
Yeah, I couldn't agree more. We have to plan for that to happen. Accountants usually tell their clients to defer income and accelerate deductions. That's the opposite at this time of the year. Accountants that I work with that are working closely with their clients are saying accelerate the income, defer the deductions.
They're even saying that when it comes to charitable deductions.
Exactly.
Because nobody's sure if the charitable deduction is going to go away either. So what about the little guy's portfolio out there? I'm talking the retail investors. Does the retail investor get impacted by these ripple effects?
I think absolutely.
Yeah.
I think you're going to see the small guy actually pay more in taxes somewhere. We haven't seen all the details of the tax plan, but I think when the wealthy stop spending or are giving it to the government, then they're going to be buying less and they're going to be investing less. And when they're buying less, that's less jobs for the working. I think there's going to be a ripple effect right down to the smaller investor.
So
and
I'm
sorry, go ahead.
No, please.
Okay, I think that the small investor is going to be scared. They're not going to invest. And they're going to cause a problem because they don't have much money to start with, and so the wealthy later on are going to be asked to pay for more of their share ongoing to pay for those who don't have it, and that's going to be the smaller non-wealthy person.
I couldn't agree more. If you're making $250 up to $1 million, that is going to affect your spending habits. Most of my clients have $1 million to $10 million in investable assets. Right. I don't think that'll affect their lifestyle whatsoever.
Robert, Robert, you said that it's $30 billion that you're raising when you raise just the $1 million folks.
Well, it's $20 billion if you just do the $1 million folks. It's $30 billion if you cut it off at $500,000. Now, whatever the cutoff here, we are at the end of an era, and the wealthy know. We've had almost 10 years of low tax rates, historically speaking, for the wealthy, and they don't like it, but they've been preparing for this. They understand the reality, and so this is not a surprise to them, but it is in the short term affecting their incomes, their spending, and more importantly, the selling of their investments and their assets. But this is an end of an age for these people, and they know it.
Well, I think what's going to happen is that people like Robert and I are going to be busier than ever figuring out how to make up for that tax loss.
Right.
I mean, that's our job, and the accountants can be busier than ever.
Yeah.
It's time for the wealthy to be smarter than they've ever been.
Oh, I couldn't agree more. Absolutely, and Robert makes a good point. The trust and estate lawyers, the CPAs, and our financial advisors like myself, we haven't been as busy like this in a long time. And in fact, when you think about it, the exemption, the estate tax exemption, gets lowered at midnight from $5,120,000 for a single filer to $1 million.
Wow.
Right, and the estate tax goes up from 35% to 55%. So we're also talking about if changes aren't made very quickly in Washington, if they don't get their act together, the estates are going to be paying nice taxes too. That's on the federal level.
So you work your whole life and you pay taxes your whole life, and then you die and you want to give some inheritance to your kids, and you got to pay 55. They have to pay 55% on it.
As of January 1st, 35% today, 55% on
and so there are a lot of kids this Christmas who are getting multi-million-dollar checks from their parents that they haven't to beat that tax increase. So that's the good side of this, I guess.
There you go.
Or charity contributions.
There you go.
That's
Thanks, gentlemen. Great conversation.